Good morning, everyone. Welcome back to another course member live stream. We are doing late United States time, but very early. Well, not super early, but 7 a.m. Europe time, which feels very early because I still feel like I'm on US time. Although, no, that doesn't make quite sense. I don't know. Everything's just messed up. But anyway, let's go ahead and start with Q&A. And then we did mention that we were going to talk about Amazon. Some of you have some questions about shorting the dollar as well. So we can talk about that. But I want to make sure the volume's okay. So let me know if you find the volume okay. Or if I could probably bump it a little bit. I'll probably bump it a little bit, just assuming it's probably a little low. Let me know if that's okay. That should be better. Okay, let's see here. So let's answer some questions here. So someone named YouTuber wants to know about drama. I have no idea why. But anyway, audio is good, volume's okay. Volume was better before. Really, I increased it. And so you prefer it lower? Anyway, okay. So yeah, let's talk. Let's stick to finance here, and let's chat. So let's see what we got. But yeah, the volume comments are fine. Okay. Yeah, Tesla files BK. That's right. Let's see. Waking up with Kevin now, going to sleep with him. Oh my gosh. Skills analysis. Wow, it's been a while since we've done one of those. I remember looking at that back during the pandemic, and I don't know. I mean, that was quite a that had a lot of momentum to it. It was never a company that I was super jazzed about, but we did say that we were going to do a part 2 on Amazon today, so that'll probably be what we do. What's interesting about the triple short on QQQ is we really on the Nasdaq haven't been pushing new lows, even as this news has just been so bad. So, for example, if we go, let's go to the day chart. I'll pull it up on Webull here. Although Webull's not as convenient. Just have to do. Well, let's go to. Yeah, I guess that'll work. No, I don't like it. Hold on, let me see if I can just do it on the computer. It's a little tougher because I have the computer in a weird spot, but let's see. I can get that moved to a better spot. Yeah, okay, I should be able to share screen. Shouldn't be an issue, but if it is, if anything, it'll just freeze me. Okay. QQQ. Okay, yeah, all right. We can do this. A little bit of a funny setup here, but I do want to show the QQQ here. All right, so we'll see if it freezes. Hopefully it doesn't. And let's just hop into it really quick. So what I want to show here is, and I want to see if it freezes. I hope it doesn't. But what I want to show here is like, these are your bottoms on QQQ. And even though we keep getting all of this crazy bad news, here are those triple bounces that we had on the NASDAQ way back in February and March. Obviously, we've moved down another, 10-ish plus percent, 10 to 15%. But we're almost coming back to that 10% line on that bottom there. And we aren't really making new lows here in July. So hopefully I wasn't frozen for that, although I can't really trust this computer. So let me know if that was okay. But that's just something that I've been thinking about. I'm like, golly, we had such a terrible result on CPI, right? I mean, CPI came in like absolute crap. PPI came in like absolute crap. Consumer sentiment is plummeting. The dollar, you're good. Okay, great. The dollar is strengthening, which you have to remember that the dollar strengthening is bad for stocks in some degree, because it makes, we have a lot of international earnings or international sales that go down when the dollar strengthens. Other people have less money to spend on our products when the dollar is strong. This is why Donald Trump, he was always cheering a competitive dollar, not a strong dollar. Which I always thought was very interesting, but makes sense from an industrial point of view. So we've had all this bad news, Yet you just saw the NASDAQ, it hit its 0% Fibby. Here's sort of your 0% Fibby. It fell beneath that, and now we've kind of done this for the last month, right? So the last month we've hit this inflection point. Sure, I mean, there's no cost to being in SQQ other than opportunity, right? That's the expense of being in SQQ is opportunity cost. That's it. But beyond that, I mean, maybe if there's a larger move to the downside, it's a potentially a decent hedge. The danger though is if we end up moving up 10%, you lose 30 on your SQQ position, and that doesn't necessarily come back very easily. Even if you get a 10% move on the QQQ back to the downside, when you swap performance, doesn't always work out that well. So I usually try to stay away from the triple leverage stuff. I'd rather, not always, but I often rather do some. There's depending on the volatility too. Some options, which could be like on QQQ. Let me look, for example. If I went to QQQ and I wanted a hedge, it's just so expensive right now in every world to hedge. I mean, I guess if you didn't want to pay the crazy option fees right now, but let's say you wanted to hedge for, I don't know, you could do these more often too. Let's say you wanted to hedge through to September. So you go to September. This we can actually do together on the iPad here. It's fine. Okay, so let's say we wanted to go to September. That's 63 days out. QQQ right now is sitting at 286. Let's say we wanted a 10% hedge. We can, if we go super out of the money and we go for a 10% hedge, that's what, 28, 30-ish dollars, something like that. It's going to bring us down to 256. Let's just go over here. Here, if I go to like 255, for example, how much is that costing me? It is costing, looks like it's costing about 20%. So if I go to 255, my midpoint's about 37. 255 plus 37 is about 292. And it's costing me about $6. So $6 on 292. $6. $6 is part of my option contract of how much again were we paying? 255. 255.37 is what we're paying. So out of the $37 that we're paying about 16% in extrinsic value there. Oh, I went to calls here. Stupid dummy. This is what happens early in the morning. Hold on a sec. Let me go to puts. Yeah, duh. I'm like, wait a minute. I'm totally backwards with calls here. Okay, all right. This makes a lot more sense. Duh. Okay, so 255. So we're gonna pay about $4.81. I do calls so much more than I do puts, but okay. So $2, $4. Okay, if I go to a $4.80 put over here, and we're at about 286 on the QQQ right now. Let me do this. We have theta decay here of about 10 cents a day. And let's say I hold this for 45 days. Hold on. Let's do 45. Well, yeah, no, $45. That's going to eat up the whole thing. See, what I like to look at is if I hold it for somewhere around 75% of the duration that we have, which would be about 45 days out of 63 days, how much money of that option have I lost? And so at 255, if I lose, it's technically 9 cents a day, but just to make math easy, if I lose about 10 cents a day, which you can see on the right side of the 255 line, so the top line there, all the way on the right side, we see about minus 9.23 cents. I'm rounding to 10 just to do quick mental math. That's going to cost me about $4.50. That's like 90% of the premium that I'm paying for this, which is pretty wild. But okay, so anyway, let's say I wanted to do that. Gosh, it is so expensive right now to do that. The volatility, 36%. Okay, I mean, those are ideas like that. These can become valuable over time if we really have a move to the downside that's quick and sudden, and that's why people will hedge with those. Let me see. Hedging with cash is always the best, in my opinion. Let me do options profitability calculator in this case. And then that way we could do a quick little calculator on how much of that you would want. I completely agree with the cash idea though. So if I go QQQ and we're at get price, okay, we are going to buy a put for September 16th at 255, 284. Okay, let's see what we got. And then let's assume that volatility goes up 25% because the market moves down like that. Okay, that's actually going to help us a little bit. Okay. There we go. All right. So in the event that volatility in this case fell, or volatility went up 25% and the S&P fell about another 10%, let's update this, then you could see that a $484 option could be worth, if the NASDAQ fell that 10% by, let's say, the middle of August, it would be worth somewhere around, looks like roughly a double per position. So that's kind of how you would end up getting a double on an option like this. It's very, very risky because what you're assuming here is that the volatility is going to go up and that the NASDAQ's got another 10% to go between now and roughly August, which would be about a month. And if you didn't have that sort of volatility increase, but you still saw a 10% bleed on the QQQ, I don't even know if you'd be profitable. And this is why options, like put options, have gotten so expensive. You would be, barely. So if I go to August, let's say 18th over here, yeah, you'd actually still have some profit. Yeah, no, you'd have a good amount of profit. You'd still have that $376 of profit on that option contract. So it's actually not terrible. And that's with no volatility. That's not bad. So if you get a 10% move down in the next 30 days, 30 to 40-ish days, you could still profit on that. The problem is, and this is where it's nasty, is if you just bounce along the bottom. So look at this. You buy that contract today, and we stay at, where we are now, which is right here about where that line is. You're going to lose 7%, the next day. Then you'll be down 13%, 19%, 24%, 30%. Before you know it, by August 18th, if you just sat there and didn't look at it, you'd be down 69%. And so that's one of the downsides. Now, if volatility went up in that time, but prices kind of still bobbed around, and this is where you have an issue as well with options to keep an eye on, because if volatility went up, that can help you. By August, if prices still kind of bobbed around, you'd only be down 40% on that hedge. If volatility went up, if volatility went down though, because we didn't really move much in pricing, look how quickly you'd lose 90%. You'd lose 90% by August 18th, if the NASDAQ didn't move at all. So options are oftentimes a very expensive way to hedge. I'll tell you the best way for options, or the best thing about options, is if you buy an option and then you have some kind of really big move to the up or the downside fast. That usually helps a lot, because then you get, if you're directionally correct, you get the biggest moves for the least amount of cost on these options, which I think is phenomenal. So that's obviously one way that you could hedge. Another thing that you could do, which is a little different, but I did this on IWM, the small caps, is you could sell puts. And so, for example, we went in and sold puts, we can do something actually very similar. And we go, let's say we go to 275 and we sell $10 puts. Let's see what those look like for giggles. Okay, so we go over here and we go to 275. We sell $10 puts, or call them the 276 puts right here. We sell these for about $10 a piece. Now, if we sell those for $10 a piece going out to September 16th, what we're really saying is we will sell you the right to force us buy the NASDAQ at 276. You're going to get paid $10 to do that. Problem is you're going to need some decent collateral if you do this over on Webull. You'll need, for 10 of these, you'll need about almost $3,000 of collateral for each one of these that you do. And, you're getting $10 per. Let's see here. Let's do an example. Let's see. $10. Yeah, I mean, that's actually kind of interesting. Let's see here. If I sell the 276, let's run through that really quick. And we'll go to Amazon in just a moment too. But I want to run through that really quick. So if I sell the 9/16/22 QQQ put, I will get a $10 premium, and I'll need collateral of about $27.60 per, which times 1,000 means I'm going to get about $1,000 of premium for every $2,760 I throw up there. Wow, that's actually not terrible. Oh, no, hold on. Buy power. Oh, no, hold on. 200. No. Sorry. Every 20. Yeah. Yep. Nope. I was off a number. See, it's too early for me to do this math because it's 276 times 100, unfortunately. So you're getting $1,000 for every. That makes more sense. 20. I was going to say, otherwise that'd be ridiculous. That's like a meme stock kind of return. So then you're getting $1,000 for 63 days on 27,600. You're getting about 3.6%. That makes a lot more sense. So that's an example, if somebody wanted to pick up, because a lot of people are actually right now investing a lot of money in bonds to try to get, 2.9% or, 3% or something like this. And so a lot of people see this market as, hey, well, if we bounce along the bottom like this, I'll just sell some puts and I'll pick up 3% in 60 days. Or even 45 days if the market moves a little bit in your favor and kind of goes up to about 290. Maybe you can get out you can realize that 3% a lot sooner. So there's some interesting ways you can do that. Obviously, the downside is if the NASDAQ goes down to like 240, you're going to be upside down because you're going to be buying these at 266, which is basically 276 minus 10. That's another option. So really, if I had to kind of rate hedges, and we've done this before, we actually did a lecture on exactly this, but if I had to rate hedges in terms of the way I would do it, I would say cash, then I'd have like a big gap, right? And then I'd probably, if I wanted to hedge, let's say I wanted to hedge tech, I would probably find something that I thought was hadn't really fallen enough yet. I'd probably short something that I thought was high. So maybe that would be like Enphase or puts. Although Enphase, I was thinking about shorting it when I left for Europe at 216. And now it's like 186 or something. I should have done it then, but oh well, woulda, coulda, shoulda. Something like that where it's still relatively elevated, especially year to date. You could do puts. But I would probably sell puts first. So shorting it, as long as the rates are low, you can sell puts, especially on companies that you want. Or let's see, you could do cash, you could do these, would be an option. I'd probably put in the same area over here. like some kind of, but I really hate these. No, I'd probably put it a little bit more down the list, and then I'd be looking at a triple short. I could also get a single short, and I'd put that over here, par with these guys. That's just personally kind of where my head would be. Alex says he shorted Enphase at 215. That's awesome. Yeah, I was talking about it. I remember we did a course member live stream and I was talking about it. I'm like, well, what would I short right now? I'm like, Enphase. Well, it's at a ridiculous price. And I was at the airport and like trying to go on my phone. The kids are screaming. And I'm like, whatever. It wouldn't have been like a massive short anyway. But yeah, okay, good. What else do we have? Closing options with a percentage game. Yeah, it'd be actually a good idea for a lecture. It's not bad. Someone says Disney is a buy in your opinion. The fact is we're past peak inflation. I don't disagree with that. There's a possibility of that. Okay, let's do a little bit of work together on Amazon because we did promise that we were going to do some of that. And we can talk about the dollar short a different time. But one of the things that I did is I grabbed a few different sheets or I figured out finally how to grab easily PDFs off of Seeking Alpha, which is really convenient. They just have a share button and you could open up as in the printer view. And then on an iPad, if you hold the printer preview, you can turn it into a PDF, which is really convenient. But the big thing about Amazon that we were talking about last time when we left off is this idea that you can get the retail division of Amazon for free when you pay a sort of a regular competitive valuation for Amazon itself. The problem with Amazon, this was the big downside, was that you were really buying a company that had this anchor of the retail business, that the retail business wasn't necessarily exploding the way that we would hope, and especially with some of their investments, you've seen losses, and so it makes it a little bit more difficult to kind of parse out the data. But we still have more net sales than we've had before. So if we go into segments over here, this is really what you want to pay attention to. Oops, let's get the there we go. Status going. This section right here. This is the AWS net sales, and this is where we have some really nice growth, because really this is somewhere around 40% growth right here, which is really nice for net sales. And these are the kinds of things, these are the kinds of companies that you really want to pay attention to, because if you can, I shouldn't say these kinds of companies, these are the kinds of stats that you want to pay attention to. Because, for example, let's say if you could continue to grow AWS at 40% and you're paying 20 times, for this company, then, how does that compare to some of the other SaaS business models? So the PDFs that I got, that's sort of just to catch you up in terms of where we left off. The other business models that we looked at, or the other thing that I wanted to do, which that was more of an intro what I just said. But what I wanted to do is I wanted to go through at least some of these AWS articles and Seeking Alpha and just kind of theorize about them together. So, for example, this person starts off with, at this all this points to is AWS becoming the main story for Amazon investors over the coming decade. Well, let's go through and see what their thesis is. Amazon's a global player in many different things, much more than a marketplace. Okay, we know they're into all of this. All right, so they go into the history of AWS. So I want to go and get into some of their actual details. An enviable business model. Okay, AWS has a powerful moat. So this I think is interesting. Let's see what their argument is. First mover advantage and its scale. When it comes to cloud providers, scale is everything in terms of bottom line profits. Amazon's early move into the industry has enabled it to benefit from a much larger scale. Okay. So I want to look at that. I want to see how their expenses are growing. Someone asks if AWS will ever split from the main business. Yeah, you might see that. It's actually a good point. So I'm going to go to the Amazon annual report, their last annual report. So I really want to see if we can break out how much their servers are actually costing them. So their last annual report came out. Let's see here. Boy, they have a long letter. All right, their 2021 annual report should have been early in the year. Let's see. All right, here it is. Okay, so May 25th. Okay, good. So it's not like terribly dated. I always hate at the end of the year on these when you have a dated annual report. But this isn't too bad. So if we now go over to income and expenses, statement of cash flows, statement of operations, we'll get some definitions here now. Okay, good. So here we have revenue. So let's see what sheet they gave us. Statement of operations. So we have net, the things we want to understand the definitions on to really figure out how we can parse out Amazon is, I believe their cost of sales had a lot to do with not just product sales, but also servers. And this I want to be very, very clear on before I go through more of their statements. So we have revenue, and a description of our revenue is as follows. Retail sales, we offer customers products through our online and physical stores and AWS. Include global sales of compute, storage, database, and other services. Revenues allocated to services using standalone selling prices and is primarily recognized when the customer uses the service. Okay. What about expenses? That's the big thing. Cost of sales. Cost of sales is primarily the purchase price of consumer products, inbound and outbound shipping costs, payment processing and related transactions, and those related to fulfillment. Okay, got it. So cost of sales doesn't actually have anything to do. Oh, but they have fulfillment separated out here. That's interesting. I think AWS is actually technology and content. Let's fact check that. So there it is. Technology and content relates to our payroll and related expenses for employees involved in research and development of new and exciting products. Okay. Infrastructure costs include server, networking equipment, and data centers, and other expenses necessary to support AWS. Interesting. And then here's fulfillment. Okay. This actually helps a lot because now we can go over here and we can say that, let's erase this for a moment, make this a little bit more clear. We can now say that Amazon's warehouse business and their product business is this segment right here. There we go. And so we're going to call this the products. Whoops. Oh, Mr. iPad. So here we have products. And then really technology and content. This is the segment of the business I want to pay attention to. This is the cost of AWS, which I wish they would just call it that, like AWS costs here, but it's all right. We figured it out. So this is AWS. So really, now we can figure a margin between these here. And we can say that AWS is running AWS sales commission under marketing, by the way. Yeah, thank you for that. That's a good point. We might have to include that too. But this we could call the operating margin. So 241, we've got 56 million divided by 241, 56 million divided by 241, about 23%. Okay, so their cost here for AWS is about 23%. I'll write that a little differently. This cost 23%. And if I throw in, now we look at marketing, Let's see how they describe that. And then I want to see how it's changed in the next quarter. Marketing, personnel engaged in selling commissions to AWS. Perfect. And then to make this money, they advertised with what percentage? Let's see. And then they spent 32 on marketing, which is obviously going to include marketing for other products as well, as they've mentioned. But let's just go ahead and include it and compare to see how those two margins are changing. And we want to see both of these margins improving. So if I take 32.5 plus 56, that's 88.5. And divide these by 241, you get about 36.7% if I include these. So 36.7% cost for tech, content, and it is true if we have, why does it do that to me? If we have content under technology as well, that could also possibly mean the Amazon Prime Video. But is that then also recognized in the revenue? Let's answer that question. Technology and content, infrastructure, doesn't necessarily say. I mean, it makes sense to me that would also include like Prime Video, right? Let's look at what they write as revenue. AWS, other. They don't parse that out very clearly. So I'm going to just ignore that for a moment. And I'm going to grab the last quarterly report now. Covered calls in this market, actually not a bad idea. Because we are so bouncy along the bottom, right? The downside is if as soon as inflation comes with a hit that comes to the downside, I think markets are going to tick up quickly and your covered calls could get burned fast. All right, let me grab Amazon quickly for the next quarter. Okay, here we go. So now we have a couple margins that we can actually use to compare and see how the company's growing, right? This is what I like doing. So now we're going to go here and we're going to compare. Oh, they give us the 12 months ended figure again over here. How convenient. It's okay, we don't really need it because we already have the data. But that was nice of them. So let's look at well, this is 3 months ended December. I want the first quarter of the year. That's what I want. Okay, Amazon. Q1, here we go. This is the sheet that we want. And then we can go over here. Okay, great. So now we can go to 2022 and we can divide a couple things. First, we're going to do 56, which is the number way up here. We're going to grab the net service sales here. I'm going to call that 60. We're going to divide 14,842 divided by 60. 14,842 59,989. So that brings us to about 24.7%. 24.7% cost for tech content of services. And that compares to the last time we did this with the 2021 report. That compares with, how do we do? Here we were at 23%. So if anything, it's gotten a little bit more expensive, but not terribly more expensive. If I include the marketing, let's go grab the marketing in there. if we now include marketing, and so I'm going to write this down. This was 23% for 2022 or 2021. With marketing, we're at cost. Let's add that in. Sales and marketing, 832 plus 832.0. 38.6%. So both of these have gotten worse. Yeah, so we were at 36.7%. Oops, let's get back to the right page here. Okay, so both of those margins have worsened slightly. It's the downside of Fundy is it takes a little time to kind of understand all the details that are going on, but that's all right. Let's move this over a little. There we go. Okay, so this is some good information. So now, how much growth are we getting again? So we're growing service sales in this quarter year over year by, I'm going to just go 60 divided by 51. 17.6%. See, that's 17.6% growth. And how much did their marketing go up? Marketing went up. See, there's no more 40% growth in that Q1. Marketing. Right. Ads, there we go. We kind of figured that out last time. Ad spend went up 34%, while service growth went up about 17.56%. So it's interesting. What I want to do is the next quarter, see if we can continue to grow AWS with less growth here, and it'd be nice to have profitability on, which we do have on the product side. Hold on a sec. Do we though? Cost of sales, cost of all sales. I'm going to duplicate this page really quick because it's so messy right now. One sec. Select, copy. They don't make that too easy. I think you divided cost from product sales, not service sales. Oops, that could be. Thank you for that catch. I see. Let me go back to the 21 report. Oh, you're right. My bad. I did. I took that 241. Thank you. So let's fix that really quick. It's just that the 23, the two numbers that we had. Good catch. I'll have to go back and fix that. Darn it, Kevin. Darn it. Fundamental analysis, first thing you wake up. Not the most fun, but it's very interesting. Okay, so let's do that correctly. 56052 divided by 28, 035, 4.58%. And then if I add in the marketing plus 32,551, it's a cost of 38.8. Let's copy this over. Okay. Okay, we'll fix that over here. 24.58. So that's better, but not by much. 38.8 with marketing. 38. 0.8. Okay. So fix that. Thank you for that. Oh, darn it, Kevin. This is the number. This is current. I'm making a mess of this. But that's all right. Cost for this. Technicon will fix it. Let's see. 24. Mm-hmm. 42. 99. Here we go. 24.75. 24.75. I mean, that's not terrible, right? 24.75. So really, their margin has stayed consistent with the exception of their marketing went up a little bit. Their marketing went up by about 210 basis points. I mean, that's a pretty decent move. So that's why I was kind of pointing out that what's next for Amazon, understanding the AWS margins, right? This is what we wrote down the last time. So let's understand a little bit what we're seeing. So we've seen marketing expand 210 BP, while at the same time, how did growth move? Well, growth went to 17.56%. What did we grow last year? Go back to the annual report here. Here we can now look at just the product growth. I mean, that's almost a double from 2019, right? That's almost a double from there. Let's do 120. 70 divided by 120. That right here is 41%. This is 41%. And from here to here, we're looking at 228, 70, 34%. See, that's interesting. You're getting this decelerating growth, right? Look, we killed it in 2019, 41% growth. You jump from 2020 to 2021, 34% growth. And so now they're advertising more. And as they're advertising more, they're now growing year over year service sale growth at 17%. Right? So we've seen that really decline or really slow down. Again, 41%, 34%. Well, service growth went from 41% to, what was it, 36% to 17%? Double check. 34%. So you're advertising more, but growing slower on AWS. But, you still have yourself a SaaS biz here that absolutely has value. Now, what I think is neat, just to compare to, because this will make you feel a little bit better about Amazon, is let's go to this particular report. One sec. Pull this up here. Balance sheet. Statement of operations. Here we go. This, what I'm about to show you, is the CrowdStrike document. And this here, look at this. You can see, just for comparison, and then we'll look at the valuation difference here. 487 divided by 302. Here's a company that in the 3 months ended Q1 is seeing 61% growth. And how much more did they advertise? They advertised sales and marketing here. Okay, so their total revenue grew 61%. Their total costs grew 361 divided by 24. Also 61%. That's good. And their sales and marketing grew 193 divided by 135. 43%. If you look at this difference, here their sales and marketing grew 43% and their business grew 61%. It's not bad. You have more growth per advertising dollar spent, but the valuation here is wild, right? Because first of all, Amazon lost money in this last quarter as well. But if we go to their projected EPS for the year, which we expect them to be profitable this year consistently, we'll compare that to AWS. Darn it. Hold on one sec. Yeah, exactly. Forward PE is like 100. That's exactly what my point was. Give me one sec. Okay. So, Bloomberg. Let's see what their forward estimate is on crowd. It's the only bummer on crowd. So EPS expectation here, we're looking at, for 2023, we're looking at $1.21. Of 2022, essentially. Call it Jan 23. And this is a company that's selling for at 169. 169 divided by 121. We're selling for about 140 times PE ratio. Compare this to Amazon. Now with Amazon, obviously a much more mature company, we are Amazon. Where did I put it? Here we go. Amazon, if I take out, it's such a problem. Let me just look at, because of the stupid Rivian loss, let me just look at the forward projected from Bloomberg as well. Let's see what Wall Street thinks. Amazon, we're looking at $1.86. So $1.86 end of 2022 and $3.61 end of 2023. I may as well get the next year for crowd as well. Ooh, see, Amazon's EPS is expected to kind of explode compared to like crowd for 2024. Jan 2024. There we go. So forward 2 years, CrowdStrike is divided 169 divided by the forward 2 years. For 23. There we go. Okay, so PE ratio, that's a multiple of about 140 times for the next 12 months. The next 12 months thereafter, you're at about 96 times for CrowdStrike, whereas for Amazon, at $110, 110.63 divided by 186, you're paying about 59.4x for 2022 Amazon. And for the next year, you're paying $110 divided by 3.61. Now you're paying about 30.4. So both of them aren't necessarily cheap. You clearly have that SaaS aspect. But the difference that you have, and then of course we could compare these to like Microsoft or Google and things like that as well. The difference of what you have is at CrowdStrike, for example, your ads are still making more or still bringing more in, right? More efficient, I should say, than AWS. But that could be because you're a smaller company, right? At Amazon, your EPS is growing faster. So kind of a little bit of a toss-up there on when you look at these companies. Let's look at Google. I like Google's valuation overall. If I just quickly get Google's last earnings, this is their transcript. Earnings. I can quickly pull that out, and we'll just do a very brief look at that. Let's look at Google. Google Investor Relations, and then we'll probably wrap up. See if we can do a quick look at Google. Hopefully we don't have to go on the annual report to understand more. All right, here's Alphabet. So they do break down Google Cloud, I think. Well, not on the consolidated income statement. Cash flows, emerging markets. Ugh. Google Services versus Google Cloud. Ugh. Look at that. Google Services. At least they give you the definition here. You don't even have to go into the other item. Ads, Android, Chrome, Google Maps. Okay, good. Google Cloud includes infrastructure and platform. Let's look at that. Okay, so Google Cloud grew by almost 50%. That's actually pretty decent. 5.821 billion. What did it cost? Let's go to their expenses. Operating income. Oh, well, they lost money. See, at least they gave us operating income. They show us their margin here. So their margin on Google Cloud is negative. So they're not yet making money on Google Cloud. And this is not exactly like the fastest ramp to making money here. You know, if you look at this, I mean, they lost money Q1 of last year, they lost money Q1 of this year, and it hasn't gotten much better. Very interesting. Google Services is where you're making money here. Shows you how challenging it is to compare these companies. Now, these things are really good to know because, for example, if you're a CrowdStrike investor, you want to see that ad efficiency. So let's write that down. And the reason for doing these analyses is so that when you do when you read earnings or earnings come out, you want to see is CrowdStrike's ad efficiency improving? You know, with Amazon, can we get more AWS growth? 17% is kind of boring. And with Google, can we get cloud to profit? I think those are the big questions for me. Maybe the fact that Google Cloud is negative relates to how AWS may be benefiting from scale and early adoption. That's a really good point. That's a really, really good point. That could be. Yeah, I mean, if Google has to burn money, light it on fire. Yeah, I don't know anything about Equinix. We'll have to look at them another time. Anyway. All right, I gotta go. Thanks so much for being here. It's fun. We'll do some more of this. Yeah. Hopefully you can learn as much as possible on these, and we'll do some more Q&A next time we do this, and I'll do some more analysis as well. Try to get, there's so much to learn about Amazon, but I think this was it took us a little bit to get to the meat, but I think we had some interesting conclusions once we compared to Google and Amazon and CrowdStrike. Of course, nowhere near complete, but definitely more insightful than more insight than when we came into this, right? And that's always the idea. So thanks, folks. We'll see you.